I'm Lydia Ahn. I'm the International Tax Partner at VSH CPAs here in Bellingham. Thank you all for joining us. Many of you I know we currently work with or have worked with in the past, and we appreciate you attending today. VSH has been working with Canadian businesses entering the US marketplace for over 25 years. So this topic is something that we're very excited to share about and look forward to working with everyone on future clients or projects together. And we hope that you all learn a lot from today and take something away.
Hi, everyone. I'm Natalie Trudell. I'm a senior manager at VSH, where I've been doing international tax and advisory for 10 years. I've had the pleasure of helping many Canadian businesses expand into US markets, and I look forward to sharing with you all today as well.
Our agenda for today is going to be covering a lot of topics at a very high level. And so we hope to get through kind of an overview, but also want to ensure we're answering questions as they come up. So we're going to start with a tax law legislative update, then cover go-to-market strategies, levels of US activity, structure planning, transfer pricing, state and local taxes, and then we'll have a question and answer time at the end. Moving forward with tax law legislative updates, we've had our election last week, which means that we know what to expect somewhat for 2025 and going forward, or at least know, maybe what's on the table. So a few things that the Trump administration has shared are affecting corporate tax rates, provisions from the 2017 Tax Cuts and Jobs Act that were set to sunset at the end of 2025. And then obviously a big item for Canadians and those operating globally is tariffs. So the corporate rate discussion from the Trump administration has floated the idea of decreasing the current US corporate tax rate from 21% to 15%. This obviously would affect the budget, and so it's not clear who, eventually will control Congress and if that will be able to be passed. With the current makeup expected of Congress and the president, some of these tax law changes and rate reductions may also need to go through our budget reconciliation process. So even if the parties all agree they want to do something, it obviously has to work with the budget. The Tax Cuts and Jobs Act from 2017 had a lot of tax incentives that are currently set to expire at the end of 2025. It seems more likely than not that those will now get extended, but of course we have to wait for this next year to see. One of the major ones was our individual tax rate is now 37%. It would revert back to a top rate of 39.6%. We also currently have bonus depreciation for machinery and equipment. And we have our current US estate and gift tax exclusion. That's also, if it doesn't get extended, will sunset back to around 7 million per person. Right now it's sitting at around 13 million. And then many individual deductions would also sunset. And we do know something about what's going into this next year, what to expect in terms of planning. So I think some of us are at ease in terms of, maybe we know what to expect from the Trump administration. One, because we've had a Trump administration before, but it's also just very unclear what's actually going to be able to get passed and what's going to work with the budget. So we'll move forward with go-to-market strategies. So part of our work in our international tax and consulting team is not only the compliance and tax aspects, but it's also really the bigger picture of helping Canadian businesses to enter the US marketplace. We see a lot of Canadian businesses being very successful in Canada, and a natural progression is for them to realize that they have targeted the 30 million potential customers in Canada, and now they want to target the 330 million plus customers in the US. And so a natural progression is we see Canadian businesses somewhat dipping their toes in the US marketplace. And more than just taxes, we also want to cover things like geographic location, target demographics, the local economic conditions, compliance, the regulatory and tax side of it, and tax incentives and free trade zones, infrastructure, and then entry and exit strategies. So geographic locations depend on what type of business we're working with, whether or not they're going to be real estate heavy, whether or not they need to be next to a port. Maybe they want to be in a free trade zone. Maybe they want to strategically be spread out across the US because they want to have distribution centers and want to have quick shipping. So those can be major factors. Where their customers are, most of the US population lies in New York, Texas, and California. So if there's a reason to need to have that physical proximity to the customers and where the major populations are, that's also a consideration. The local economics also can vastly differ across the US, and something sitting in Washington State and under Vancouver and having Seattle, we have our own kind of Pacific Northwest corridor that sometimes what's going on in our local economy isn't the same as what's going on in the South or even the East Coast. So you have to consider that each area of the US is going to have different economic conditions. Regulatory and tax compliance also play a big part in when Canadians enter the US marketplace. And Natalie will go into this further, but it determines, what state you want to register in, what state you want to have employees or an office in, and how that is going to affect your tax compliance. Some states, and it's mostly on a state basis, but we do have federally also tax incentives. And some states within them have free trade zones, and the ports also have incentives to bring businesses in that are going to lease their space, bring jobs, and bring growth. And then what type of infrastructure is needed is also part of planning. How much cash is needed? Where is the cash coming from? Is it coming from Canada? Is it coming from loans? Are you raising funds from outside investors? How is that all going to take place? And then your entry, and more importantly, sometimes your exit strategy. So some Canadian businesses are expanding to the US because they want to grow their global presence, because eventually, they want to sell in 5 to 10 years to perhaps one of their competitors. Obviously, globally, everyone's seeing a lot of mergers and acquisitions and investment from PE firms. So we want to start planning immediately for what the exit strategy looks like for the founders and the ownership group. The other part of entering the US marketplace is having a good team in place. And many of you attending right now are part of those teams. So we work a lot with US and Canadian tax consultants. Sometimes the US consultants is just our firms. We also work with a lot of other advisors and firms within the US who provide other specialties. And we work with a lot of Canadians who provide specialties on the Canadian side. VSH's approach to being cross-border specialists on the US side is that we really stay on the US side, and we defer to Canadian experts on the Canadian side. We love to collaborate and feel like that's the best scenario for businesses, is to have experts on both sides that are coming together and collaborating. And of course, we need attorneys, whether it's business attorneys, estate planning attorneys, IP attorneys. So we're always looking for them to be part of the team. Banking and financing are a huge issue. US companies and even Canadian companies really need to figure out, how are they going to collect US dollars from customers? How are they going to pay their bills? How are they going to take advantage of any US opportunities for businesses? So having that banking relationship is very important from the beginning. And a lot of what we do is connecting resources together. So if you ever need banking resources, please reach out to Natalie or I, because we do have the banking contacts that specialize in working with Canadians. Immigration attorneys is something that comes up a lot. So when those Canadian businesses are expanding to the US, they either need visas for the owners or eventually visas for employees. And that's a big part initially that we want to know about, because that affects the structuring. So we want to have the immigration attorney as part of the team advising on the right structure so you can achieve your goals with if visas need to be sponsored for workers to enter the US. Insurance is something that we continually bring up because we want to make sure that your US operations are covered, that if you're building a lot of wealth or a lot of assets in the US, that that's also covered. And it's something that sometimes doesn't always get thought of. It's also important to make sure your employees working in the US are covered, or if you need a separate plan for them. So anything, you're doing something in another country, you want to make sure that your insurance carrier knows about it and is covering you, or you can take steps to get additional insurance for the US. Customs brokers. So with all the news about tariffs from the Trump administration, nothing's for certain. We're hearing, 10% for Canada is, as high as 60% for China or Mexico. So a lot of different percentages are floating around, and making sure if the business is importing into the US, making sure that customs issues are handled and there's no surprises and extra cost there is important. And of course, as part of the team too, you want to have your human resources and your payroll covered. So we work a lot with payroll providers to make sure that Canadian companies can, and eventually maybe their US subsidiaries can employ workers in the US and have payroll set up. Payroll is very complicated in the US because each state and sometimes even within states, localities have different tax systems. So we generally don't recommend that companies try to tackle the payroll themselves from the start, and really work with a third-party provider who's going to ensure that all the compliance is done, especially if you're working in multiple states. Marketing is a big reason we see Canadian companies wanting that US subsidiary. Sometimes it's just easier to market in the US if you have a US company and you have a US presence, a US bank account, and are getting paid all within the US. But just kind of that marketing aspect of customers might just be uncertain of how to work across the border. And so by taking kind of the border away from your customers, by having a US subsidiary and being able to market that way, we find that to be kind of a top reason that Canadians do want a subsidiary. Your operations team, your third-party logistics provider, those are really important to make sure your goods, whatever you're selling in the US, can get where you need it to go. Accounting, of course, we always want to push for having a good accounting team in place. One of the services that we offer is to work with internal accounting systems to walk alongside them and a bit educate them and offer support as they're setting up their accounting system for the US branch or for the US subsidiary. Obviously, our accounting systems are generally the same, but we do have some differences and just kind of reporting, and we can offer tips and best practices. So when it comes to compliance or when it comes to financial statement preparation in the US, that you're all set up. Real estate, if you need real estate in the US for your operations or your investments, having someone on your team to help with that is important. And of course, other advisors as part of your team. And our motto is to work with the whole team. Sometimes we help lead the team. We definitely have resources to add to your team. And so if you ever need anybody, that's on this list to provide these services, please reach out. We'd be happy to connect you with our network.
So, when getting to know a business and where it's at right now and what its plans for expansion into the US are going to look like, We like to think about it in three different scenarios because they have different implications and steps that are going to go into getting set up in the US. The first scenario is when the company is protected by the treaty. So this is where we're really talking about Canadian businesses who are selling goods or services to US customers, but they don't have any physical presence in the US. I'd say most businesses that we see expanding start out in this scenario. And then in some cases, it works to operate like this long term, but other businesses need to ultimately set up an actual US entity in order to meet their objectives. Having regular sales to US customers likely constitutes doing business in the US for our federal tax purposes, but we have the US-Canada Income Tax Treaty that can protect certain minimal activities in the US. This is important to keep in mind for federal purposes, but not all states accept the federal treaty. So a business that's in this scenario with minimal US presence should verify with a US tax professional that their activity is in fact protected under the treaty and obtain identification numbers and file a federal tax return to claim that protection. It's also important for these businesses to determine if they have any state registration and filing requirements for tax purposes. I'm going to talk a lot more about state taxes later on in the presentation, but we do find that businesses might start out, right away with state tax implications, but definitely as they grow, there's going to be state tax issues. Scenario two is a Canadian business whose activity in the US has exceeded protections of the treaty and is considered a US branch. So it's no longer protected from federal taxation. We think of Canadian businesses who not only have sales to US customers, but they're also having employees working regularly in the US, or they've set up an office in the US. The key here is that they don't have a separate US legal entity yet, and all of this is being done by their Canadian company. We find that this can present a lot of complexities, so we don't often see our clients conducting this activity through their active business activity through a branch on a long-term basis. Usually when activities reach this level, it's best to form a US entity. There are specific steps for setting up your US branch, but they're very similar to those with a US entity. So I'll go through those in a little bit more detail after I go through the next scenario. So the third and final scenario is when the Canadian business has come to the point where they are setting up a US subsidiary or legal entity for their US operations. The decision to set up a US entity and how it should be structured are always going to need to take into consideration the unique objectives for each client. Lydia talked about some of those, oftentimes it's the, clients, our clients, customers want to have a US business to work with. Sometimes it's for regulatory purposes. There's legal reasons why they can't, where they need a US business entity in order to conduct their operations in the US. Sometimes it's for labor reasons. They need those employees to be employed by a US business. In many cases, there is significant Canadian activity going on that has to be then transferred into a US entity, and we can help navigate through that process and work alongside the Canadian professionals because there is going to be a lot of implications on both sides of the border when we have that situation. So if it's been determined that a US entity is appropriate, the next question is what type of entity and how it should be structured. So the most common types we see are corporations and partnerships. The corporation has a lot of obvious benefits. There's our 21% corporate tax rate. This had gone into effect in 2018, and as Lydia discussed, there isn't an expectation this is going to change in the near future. Corporations also have less complexity in general. So the compliance is more streamlined and investors don't have to file their own US tax returns or have tax ID numbers. There's also no annual withholding requirements on income for corporations like there would be for partnerships, both at the federal and state level, and therefore state tax returns are also a lot simpler to file for corporations. Now, the obvious drawback to a corporation is double taxation. This specifically may be less appealing for US investors, currently investing in the structure or who you may want to um, appeal to investing in the future. A lot of US investors are looking for a flow through structure, but that's just one consideration. A lot of times the corporate tax structure does end up working out well for Canadians on a worldwide tax basis. So stepping back, there's a lot more factors to consider just beyond, partnership versus corporation. There's the overall worldwide structure. There might be existing entities or operations that need to be taken into account in the structure. And then there's also the question of whether a US entity is even necessary. So some examples of these important issues that we have to consider in structure setup is shareholder residence and citizenship. There is going to be different considerations if their owners are all, Canadian residents and citizenships, or if we have any US citizens in the structure. Immigration requirements, Lydia touched on this, but that's very important in a cross-border structure if there's going to be visa requirements and employees being sent cross-border. And there's a consideration of whether the owners are planning on relocating to the US in the future. The stage in the business life cycle can impact the structure, especially because if they're, going to be exiting soon, or if they're just in a startup phase, there might be different incentives. So the plans to sell the business and if they're in a startup phase can be important to the structure. The reinvestment or repatriation plans of the company impact the structure. We like to, have an idea of whether the business is going to be reinvesting on a long-term basis in the US, or if they're going to want to be sending profits back to Canada, and kind of the time frame on that they might envision. Worldwide tax efficiency, of course, is often top of mind for businesses as they're expanding into other countries. That's definitely something we have a lot of experience advising on and coordinating with professionals in other countries. The liability protection provided by the entity is a big consideration. Estate tax protection provided by the structure is something to consider, because Canadians do have exposure to US estate tax when they have direct investments in US assets. Financing needs, is an equity investment versus a bank loan going to be necessary? And then there's other issues that may or may not be, more or less important to a business owner, like the administrative burden or compliance costs that's associated with the structure that they're going for. So because we do advise specifically from the US perspective, our collaboration with Canadian advisors during this process is really essential. As Lydia discussed as well, this really is what we view as providing the best service for our clients and ensuring that they have the optimal situation on both sides of the border and globally. And then, once we have a plan in place, we like to take the position and responsibility of ensuring that it's executed to plan, and we can coordinate with the other professionals who are involved in it, as much as is necessary or appreciated by the client. So once this structure is determined and it is time to execute the plan, um, I have some steps lined out here. The business entity can then be set up. So the first step is to identify what state it will be organized in. Then once it's formed, obtain an EIN, open a US bank account. This is something that is, especially important to get moving as early as possible. There can be some challenges getting US bank accounts set up when there is non-US ownership. That's something we have, experience with and can help facilitate that process for our clients. Another initial step is to set up US accounting software, either with your internal accountant or outsourced. And that's another step where we can facilitate the outsourcing or just, come alongside your internal accountants and get that set up. Obtaining insurance, and importers will want to consult with customs brokers. This is going to be, an evolving issue and something that we can facilitate going forward as well. And then lastly, just determine what state and local licenses, permits, or tax issues need to be addressed. So beyond just the initial structuring, we like to help our clients proactively plan for future aspects of their business. The cross-border issues we're specifically advising on include worldwide tax planning, transfer pricing, and repatriation. Those are just, the ones that come up all the time. A lot of these rely on our collaboration with Canadian professionals, and then we can coordinate and ensure compliance is met on both sides of the border, since we do rely on each other quite a bit for information. Now, I know this has been a lot of detailed information on getting set up, but my hope is that this can at least get you, thinking about these things, moving in the right direction, either for you or for your clients. Yeah. So again, feel free to send your questions through the Q&A. Do we have any questions that have come through yet?
No, I don't see any questions yet.
Okay, well, we'll definitely take more questions at the end.
Thank you, Natalie. Our next topic that we are going to transition into is transfer pricing. Transfer pricing is a topic that we aim to address in the beginning with all businesses, especially Canadian businesses that are entering the US marketplace. And transfer pricing at the highest level to think about is really the requirement by countries to use market arm's length terms when working with related parties in different countries. Having a transfer pricing strategy and some best practices in place is really critical for any of the cross-border structures that we're discussing. Part of transfer pricing is just to mitigate risk between both countries, and also to make sure that you have done benchmarking and maybe eventually a transfer pricing study, and then also to determine if maybe just an informal approach can work from the beginning. Our approach to transfer pricing is to scale it for how the company is operating. It has to be affordable, has to work with your structure. But we also want to know when it's time, to advise that, okay, now the company really needs to have a full-blown economic study so they have the proper documentation in place so that all parties on both sides of the border know what the terms are required. And really, this comes at different stages for companies. And so sometimes from the initial standpoint, we just want to make sure companies are aware. And then we want to make sure companies are documenting it. And then eventually we're pulling in our resources to provide if a full-blown study is needed. The IRS requires documentation, and documentation can be in its simplest form an invoice. We would like the invoice to have details on it. For example, the Canadian parent company is invoicing $10,000 a month to its US subsidiaries because this is covering overhead that the Canadian company is providing to the US company the $10,000 was determined because it was based on hours times cost for payroll, or commonly we see it's determined based on US sales over worldwide sales multiplied by overhead. So some type of documentation that's applied consistently year to year needs to be in place. And the whole point is that the US and many other countries require that each country should be reporting their fair share of taxable income to the country that they're operating in and that they're receiving benefit from. So documentation must be contemporaneous. It means it has to be timely and it has to be consistent. And in some cases, it really does need a full-blown economic study. And for really large corporations, that may be 400 pages of documentation and support. Generally, that's not the size of companies that we are working with, and we don't see those often, but that it is something that could be on the horizon for companies. And just applying it consistently year to year is important, but we also want to reevaluate it periodically, and that could mean at least annually we're checking in, does this transfer pricing policy still make sense? Or it might need to be changed mid-year. And reasons why we would see changes taking place are now you have salespeople in the US, now you have employees in the US, you set up an office, and now the US people, the salespeople, the office, they're actually generating more value for the US, and maybe now it's actually more economically appropriate to have that taxable income in the US. So we want to know when those changes take place so we can advise if that transfer pricing policy needs to be reevaluated. And we're advising from the US side, so other countries have their own transfer pricing requirements, which generally should all be the same objective, right, of third-party market terms. However, the US does have specific methodologies that can be used, and those may differ slightly from other countries. So we want to verify that this also works for Canada's rules. Substantiation, have invoices, have payments, make sure they're paid. Hopefully they're not sitting in a due to from account, which sometimes we see. So it's best if those can get invoiced monthly and paid monthly, so the accounting records show timely and consistent payments. And also, so financial statements on both sides are reflective of the economics. So when we see that the correct transfer pricing entries are not being made, that can significantly throw off the net income of the US or Canadian company, and therefore proper planning can't be done throughout the year. Transfer pricing compliance is really about minimizing the audit risk, optimizing the worldwide tax, and then also meeting cash flow objectives. So the audit risk is really from the US side. The large business and tax division of the IRS occasionally identifies transfer pricing as something that they are going after. So we really want to make sure that the financial statements and tax returns are presented in a way to show that transfer pricing is being considered. And the worldwide tax is to ensure that both countries are paying their fair share of tax. With a 21% corporate federal tax rate in the US and Canada's corporate tax rates, sometimes we're having discussions with Canadian accountants, and it's kind of determined that maybe the tax rates between the two countries, depending on the level of income, is maybe it's about the same. So maybe there's really not an incentive for one way or the other, but we just want it to economically make sense so that it's appropriate for the facts and circumstance. And cash flow, so if the Canadian company is financing all the overhead and they're paying payroll and they have the facility, then we want to make sure that they have the cash and it's not all being accumulated in the US company, which may have very little expense but a lot of revenue. So we're trying to meet these objectives with putting some transfer pricing best practices into place. In our diagram here, we have services and value. And so oftentimes, initially, we do see the Canadian parent is providing services and they are providing value. And the US subsidiary needs to pay fees and move profit back to Canada. However, in the life cycle of the US subsidiary, we do see that shifting. So eventually there may not need to be such a need. For some of the companies we work with that do have intellectual property in Canada, there may always be a transfer pricing element by way of paying some type of royalty back to Canada. And that would be forever unless the IP is actually moved into the US, which is a possibility. So transfer pricing is something to address with any level of activity for a company in the US. It just, based on the level, it would then dictate how much energy and expense is going to be spent on transfer pricing. But at a minimum, keep in mind, you need to have market terms, especially between related parties, especially when payments are going across the border. And I'll pass it back to Natalie.
Thank you. All right, now I'm going to shift gears a little bit and talk about state and local taxes. This one can be one of the biggest culture shocks for Canadians as they, get into business in the US. I talk with a lot of Canadian business owners who are expanding into the US, and it can be really exciting, but also overwhelming. And the state taxes seem like one of the overwhelming pieces. So we like to, have a really good high level understanding of what the state tax situation, what the state tax laws are, so that we can, find out from our businesses what they're doing, where they're doing it, and help them make the process manageable to, ensure they're compliant with state taxes, or at least understand what their exposure to state taxes is. So this chart right here shows the corporate income tax rates for each state. This is one of the many different ways that there are differences in state taxation from state to state. So the state laws not only vary in tax rates, but they also vary on which businesses are subject to tax. The concept of nexus is the connection between a business and a state that has to exist in order for the state to impose its tax. There's multiple different types of nexus, but the most common one we deal with is economic nexus and physical presence nexus. So merely by selling to customers in a state, a business can be subject to tax. And this is the concept of economic nexus, which means you're benefiting from that state's economy. A state's tax may also apply if you're physically present in the state. That could include having employees in the state. They might even just be working from home. They might be activities of your independent contractors in a state, or just having, physical inventory or an office in the state. Specifically how this applies is different from state to state. So something that does need to be evaluated. The states also differ on the types of taxes that they assess. Some of the most common ones are listed out here. We're going to specifically be talking about income taxes and sales taxes. So specifically, I did want to address some nuances of state tax laws and how they apply to non-US businesses. So if we're thinking about a Canadian business who is in scenario 1 that I discussed, where they're selling to US customers, but they're not actually subject to federal taxes, they are protected by the treaty for federal purposes, they might still have state level tax issues. However, some states do apply the federal treaty protections for state purposes. So for example, Florida does extend the treaty protection to non-US businesses, but California doesn't. So a Canadian company that sells to customers in both of these states might be subject to the California income tax, but not Florida. There's also a nuance regarding Public Law 86-272 that I wanted to address. So just some background, this is a public law, or this is a federal law that prohibits states from imposing their income taxes on This is a federal law that prohibits states from imposing their income taxes on companies that only have a minimal level of sales activity in the state, specific to sales of tangible personal property. So if you might have sales to customers in a state, but if you don't have any physical presence and the only activities of employees in the state are just selling activities, you don't have to pay income taxes in that state. There are nuances to how this law applies state by state. Some states apply it to non-US businesses and some do not. So if you are, selling to, for example, New York, you will be protected under Public Law 86-272, but if you're selling to customers in California, you wouldn't. So again, this might be something that has to be taken into consideration in an entity structuring. And further, if you are protected by either the treaty or Public Law 86-272, you wouldn't have a income tax obligation, but you might still have to file a tax return in order to claim those protections. Lastly, another nuance to consider is that non-US businesses are subject to sales tax laws just the same as any US businesses. Sales taxes are a transaction tax, so they're not actually an expense of the business, they're an expense of the customer, but the business is responsible for collecting them and paying the taxes. However, if a company fails to collect it from the customer and are subject to the collection requirements, that obligation transfers to the business. So if they hadn't been compliant with their sales tax collection, it could essentially be a gross receipts tax of up to 10%. So clearly, sales taxes are a really big deal for US business, regardless of who's conducting the activity. But before you are going to undertake the huge burden of collecting sales taxes in every state, you have to determine if you're subject to those requirements in each state. States have enacted economic nexus thresholds, which provide a bright line test for determining if you're subject to sales tax. Each state has a dollar threshold for this determination, and some states also have a transaction thresholds. So in some states, you might have low dollar values, but could quickly meet the transaction threshold. In addition to economic nexus laws, all states that have sales taxes have also adopted economic nexus standards for marketplace facilitators, which is, businesses like Amazon. So this means that in a lot of cases, the Amazon or other platform is going to have the responsibility to collect and remit sales taxes rather than the, individual sellers who are selling through those platforms. Unfortunately for businesses, no two states have the same sales tax laws. So in addition to differences in nexus thresholds, states may also have differences in which products and services are subject to the tax and how a sale is sourced to the state. And then once you determine, you are subject to tax in a state and are collecting, they might have different filing frequencies or, different tax returns for each jurisdiction. This, is not only at the state level, it could be at the local level. And so this, lack of uniformity has made a lot of compliance burdens for businesses. And so because of this, we do see a lot of companies that are relying on technology or third parties to handle their sales tax compliance for them. If there's any ambiguity on the sourcing or the taxability, those are things that we can help you determine. But then once those determinations have been made, we really do encourage outsourcing the internal accounting software and the filing of the tax returns for sales taxes. And then we also help our clients with identifying resources for those purposes, and then we can help them onboard them. In today's climate, we see that a lot of states are even more aggressive than the IRS when it comes to collecting their tax revenue. We see this come up as a really important part in due diligence in merger and acquisitions and business sale transactions. So, this is something to identify early on as possible and advise our clients to proactively address and be aware of their state tax exposure. So as a business entering a new US market, we have some considerations listed out on this slide. The first step is definitely to identify which states their business has a connection to. So where were they organized? What states do they have sales, property, and services performed by employees or contractors? They would then want to work with a US CPA to determine where they're subject to various types of taxes. Businesses then need to register in the states where they're doing business under these laws. State registration is an important step because it allows a business to access that state's court systems. This can be an administrative burden, so we do typically recommend an attorney or registered agent assist with the state registrations. And then those services can also be really useful for ongoing filings like annual reports and business license renewals that all have to be done state by state. If a company's product or service is subject to sales tax, they will then need to set up to collect and remit this. Some businesses are selling through online platforms, so this is already handled. And then in other cases, they're going to use a software that integrates with their point of sale system to show up on invoices. So as you can see, state and local tax compliance can be really overwhelming. And our approach is to understand our client's business and their goals so we can identify what information is relevant to them and their situation. Then we can break down the process step by step and ensure they have a plan to be as compliant as they need to be. We strive to meet them where they're at and, check in regularly to see how they're doing and if there's been any changes in their activity. This is really beneficial to identify, changes in state tax issues or just business issues in general that are inevitably going to evolve as they, move through their business life cycle and, are involved in their non-home country market. So now that we've explored some key considerations for expanding into the US, we wanted to kind of sum it up with these key takeaways.
Thanks, Natalie. So our key takeaways are really that we are part of a trusted team of advisors, and having that team in place is critical. And there's no one size fits all structure for entering the US. Our current, tax rates and I think with both countries' current structures, there's limited options, but there's definitely never just one option for entering the US. And state and local taxes are really relevant just as much as federal taxes for Canadian companies. And from a practical standpoint, states have a higher budget for auditors. And it's more likely that companies will get audited by a state than they will by the IRS, just because of the the budgets that both agencies have for auditing businesses. So we don't want any Canadian companies to miss complying with their state and local tax. And Natalie, I see that we do have a few questions here. The first one is from Mary, and she asks, a Canadian company starts selling wholesale products to US customers. So I'm gonna highlight that it's wholesale, meaning it's to other businesses and you're reselling and you've got a reseller's permit collected from them. And then the products are shipped through a brokerage firm. The brokerage firm is important because that's especially for state and local taxes, where the title of the product is transferring is important. There is no office or employee set up in the US, but a Canadian salesperson may visit the US customers, very common. Is this situation creating cross-border issues? And the answer is always yes, but to what level? Natalie, do you want to chime in on a few of the cross-border issues we would see in this type of situation?
Yeah. So the sales are being made directly to US customers, regardless of the shipping, is going to prevent the Canadian company from being physically present in the US for, shipping purposes, but those sales are attributed to the Canadian company that's selling them. So that kind of connects back to the scenario one I described, where you have a Canadian company selling to US customers. They're most likely protected by the treaty. That Canadian salesperson that visits the US, we would want to make sure that they're, specifically being protected by the treaty and those provisions based on number of days in the US or whether they're closing contracts in the US. And then, to be on the safe side, file a protective tax return.
And then we have one more question. If a Canadian company is using Amazon as an example, then does it still need to register at the state level? So we do see a lot of Canadian companies selling on Amazon, usually through a US subsidiary, and most of them are using the Amazon's own internal, the for sale by Amazon option. And if Amazon is clearly taking on the sales, sales tax compliance, then that should just be very clear. But you still may need to register with states for income tax purposes. And really, the Wayfair case from 2018 established economic nexus for sales tax for online retailers. And so it really is focused on the dollar amount and number of transactions. So the answer is yes, you may still need to register at the state level for other compliance purposes. And that's something that, again, would want to be evaluated